Meet Fred. He is a cabinet manufacturer. He has a plant that can make 1,000 units per year. At the moment, he's selling 500 units per year and is making minimal profit. He asks himself, how can he increase his profits? And what happens if he changes the price that he sells his cabinets for? He has a great idea and goes to an accountant. The accountant introduces Fred to cost volume profit analysis, or CVP. CVP can be summed up by this graph. The three lines in this graph sum up the major cash flows of Fred's manufacturing plant in its current configuration. The red line represents fixed costs, such as rent and insurance on the plant. These costs are incurred regardless of the number of cabinets made or cabinets sold. The blue line represents how much money the plant makes based on how many cabinets are sold. Finally, the yellow line represents the fixed costs of the plant plus the costs to make each cabinet. This means that the total costs will increase when more cabinets are sold. Also, there is a special point where the blue and yellow lines cross, right here. This is where the plant makes as much money as it spends, also known as break-even. In CVP analysis, we will see what happens to Fred's manufacturing business when we play with these three lines. Fred's first idea is to reduce the price he sells the cabinets. This will increase the amount of units he sells, which he thinks more sales equals more profit. Let's see what happens when we modify the selling price of Fred's cabinets. Here we see the same graph as before, with two extra lines. The purple line is when he sells his cabinets at 20% more. The yellow line is when he sells his cabinets at 20% less. At 500 units, which is what he's selling at the moment, he's making the profit between the red line and the blue line. If he increases his cabinets, his profit becomes from the red line to the purple line, assuming that he sells the same amount of cabinets, which at a higher price, is it likely? Who knows? Though if he sells his cabinets at 20% less, at 500 units per year, he's actually making a loss. He would actually need to sell twice as many cabinets to be making the same profit as he's making now. Fred's second idea is to reduce his fixed costs, like move to a plant where the rent is cheaper. Let's see what happens when we play with the fixed costs. In this graph, the dashed lines, these ones here, represent higher fixed costs, and the dotted lines, these ones here, represent lower fixed costs. Higher for dashed, lower for dotted. The important thing to note is the break-even point in these scenarios. His current break-even point is 400 units, so that extra 100 he's selling per year is all profit. If his fixed costs go down by 20%, his break-even point goes to 300. So after 300, his next 200 units are all profit. Though if his fixed costs increase by 20%, his break-even point is 500, so he's not making anything. Fred's final idea is to find a cheaper wood supplier. This will reduce his variable costs. Let's see what happens when we play with Fred's variable costs. Here we have again two dotted lines. The purple one is an increase in variable costs. Say for example, his wood manufacturer increases their costs, and the green one is where Fred finds a new wood supplier and sources his wood for cheaper. At his current selling rate of 500 per year, his profit would become almost nothing if his seller increases his prices, but if he does manage to find a cheaper supplier, he can almost double his profits, and break-even goes from 400 to roughly 300 units per year, which is great for Fred. What else should we consider? What will it actually cost Fred to reduce his variable costs or his fixed costs? And what will the effect be on units sold by going cheaper or going more expensive? Now that you are a CVP analysis expert, you can advise Fred on what he should do. Thanks for listening. The end.